Assalamualaikum and hi to all students. Now we're going to look into several methods as what we already learned in the last sessions about the CVP analysis. Now it's just like revisions. We have to look into different situations in order to understand what is the CVP analysis. Okay, we have several learning objective in us to understand what is the CVP, and then the first learning objective is to understand the assumptions underlying the cost volume profit analysis. Okay, in terms of the CVP, the first CVP assumptions and the terminology, changes in the level of revenue costs arise only because of changes in the number of product or services unit produced and sold. So when we talk about the changes in revenue, so this refer to any shift or adjustment in the income generated by selling product or services. So revenue can goes up or down depending on the various factors. In terms of the changes in cost, so which means that any alterations in the expenses is incurred by the business in the process of producing and selling its product or services. So the costs may include things like materials, labor, rents, utilities, etc. And then the second actually is the second assumptions and the terminology that you need to understand is that total cost can be divided into a fixed component and a component that is variable with the respect to the level output, as what we already understand. So which means that um, the total cost itself actually is referring to all the expenses by the business in the producing a good and services. Total cost include both fixed cost and variable cost. So as you know that the fixed component like fixed costs actually expenses that remain constant regardless of the level of production or output. So these costs actually do not change with the numbers of product or services produced, like rent, salary, permanent employee, insurance premium, for instance, and then the variable component. So the variable costs actually are expenses that fluctuate in different proportions on the level of production or output. These costs increase as the production increase and the decrease as the production decrease. Variable costs typically include the items such as like raw material, direct labor, and maybe wages paid for the working, wages paid to the workers directly involved in production. Okay, the third assumptions and the terminology of the CVP is when graph, so the behavior of total revenue and total cost is linear, which means straight line in relations to output unit within the relevant range and the time period. So it means that if we look into the total revenue, it means this refers to the total amount of money earned by the business from selling its product or services. So it includes revenue from all sales made within a specific time period. And when we refer to the total cost, it will actually is represent all the expenses incurred by a business in producing a good and services, including both fixed and variable costs. And the linear behavior, when we say that the behavior of the total revenue and total cost is linear, it means that when graph, their relationship form a straight line. So in other words, as the level of output, the number of unit produced and sold changes, the total revenue and total cost change proportionately. So resulting in a straight line relationship on the graph. And relevant range, it means that relevant range and time period. So the relevant range refer to the range of the output unit or activity level where the linear relationship between total revenue and total cost hold true. So which means it is important to note that this range may vary depending on the business and its operations. So the time period refers to the specific durations over which the total revenue and total costs are measured and analyzed. So it could be a month, a quarter, or year, etc. So it goes to the fourth assumptions and the terminology. So it means that it was mentioned that the unit selling price, unit variable costs, and fixed costs are known and constants. So these costs, which mean so these costs remain, unchanged and within the relevant time period or operational range. So the unit selling price remain the same per unit sold, the unit variable costs remain constant per unit produced, and the fixed costs remain consistent regardless of the level of production or sales. So this understanding that these costs are known and constant allow business to make more accurate financial projections, analyze profitability, and make informed decisions about pricing strategy, production level, and overall business operations. So it also provide a stable foundation for planning and managing the financial aspect of the business. So this is the assumptions that is very important in order for us to do the CVP analysis. So in the another assumptions on the and terminology for the CVP is the analysis either cover a single product or assume that the sales mix with when multiple products are sold with remain constant as the level of total unit sold changes. So when we are referring to these, single product, analysis, single product analysis. In this case of a single product analysis, the focus is solely on one specific product that the company produces or sells. So all the financial calculations such as revenue, cost, and profitability are based on the performance of this singles product. And then in terms of the mix, the sales mix, constant sales mix this is applied that when analyzing, even that when analyzing the multiple product, the assumption is made that the proportion of sales for each product remain unchanged regardless of changes in the total number of units sold. So these assumptions may or may not hold true in the real world scenario, as sales mix can fluctuate due to the various functions such as customer preferences or market demand, pricing strategy, and the professional activity as well. So it may be convenient to add and compare revenue and cost without considering the time value for money. It's important to recognize that this approach overlooks the potential impact of interest rate, inflation, and the opportunity cost of capital over time. So therefore, it is more sophisticated financial analysis that the time value for money is often considered to provide more accurate pictures of business and financial health proposition. So these few weaknesses that we need to consider in terms of do the CVP analysis. Okay, so based on the CVP assumptions and the terminology, so the formula is for the operating income is total revenue from the operations minus with the cost of goods sold and operating costs. And the formula for the net income actually is equal to the operating income minus with the income tax. If the income tax information is given, then you need to minus with the operating income in order to get the net income. Here, objective 2 explains the features of CVP analysis. Okay, in order for us to explain the features of CVP analysis, let me see these examples. Okay, now we are in the situation whereby we have to assume that the pan shop can purchase pan for 32 ringgit Malaysia from a local factory. Other variable cost amount is to 10 ringgit per unit. And then the local factory allows the pan shop to return all unsold pan and receive a full 32 ringgit Malaysia refund per pair of pants within 1 year. And then the average selling price per pair of pants is 70 ringgit and total fit cost amount to 84,000 ringgit Malaysia. So this is the situations. Okay, refer to the information that we have. Let's say, okay, the question asks us how much revenue will the business receive if 2,500 units are sold. So in order for us to answer these questions, we need to know actually what is the selling price. Our selling price 70. Okay, and then we also need to know how much that we need to produce. So to set the price. So it's just a very simple that we 2,500 unit times by 70. So equals to how much? 2,500 times by 70. So we got 100 ringgit in Malaysia, 175,000. So this is the answer. Okay, then the next questions, let me see the next questions. Okay, this is the first questions that we need to solve is how much the variable cost will be the business income. So how much? So we from the first questions we got these the revenues of selling 2,500 unit that sold is equivalent to ringgit Malaysia 175. So we put it here first, and then in order for us to get this variable cost, we know that the formula of total cost actually is fixed cost plus variable cost. So we find the total cost first. So how much the total cost? So the total cost of selling of 2,500 we time by their 32 plus 10s and equals to 2,500 times by 42. Let me see, 5, 42. So 105. 105,000. And then how to find out the variable is just the total says 175. You minus with this one total 105. You minus with this fixed cost 84,000, and then you get the answer of 14 negative. So it means this is the variable cost. Okay, now the question asks you what is the contribution margin per unit. So the question asks you in terms of per unit. So what information that you have now is the selling price of 70. You minus with this 42 thousands, and then you get 28. So this is the contributions margin per unit. And then next question, they ask you what is the total contribution margin when 2,500 pair of pen are sold. So you got the answer of 28 contribution margin, just times by 2,500, so equivalence to 70,000. So this is the total contribution margins. Okay, look into this question. They ask you what is the contribution margin percentage. Then you have to know that in order for you to calculate the contribution margin percentage, or we can call it contribution margin ratio, is the contribution margin per unit divided by selling price. Divided by selling price. So we got per unit is contribution margin is 25 divided by 70. You can get the answer is 40%. So 40%. The contribution margin in terms of percentage. So if let's say if the business sell instead of 2,000 plus, then they come up with this 3,000. For instance, like if the business is sell for 3,000, let's say they sell 3,000 pair of pens. So the revenue could be 3,000 times by selling price times by 70, and so the answer is 210,000. So, and then the contribution margin actually is the from this is the 40% times by these figures, and then you can get 84,000 ringgit Malaysian. So this is how it can be calculated in terms of the percentage. Okay. Okay, now let me refer to this learning objective. Determining the break-even point and output level needed to achieve a target operating income using the equation contribution margin and graph methods. So this is the formula for break-even point, which is this is the total revenue and this is the total cost. So which means that in order to get the total cost, you need to fixed expenses plus with the variable expenses, you can get the total cost, and the sales is the total revenue. So this is the equation. So if any figure that you can find out, you can replace and get the answer. So we are going to use the same questions to answer using the equation methods. Okay, we find out how much how many break-even unit in terms of this equation method formula. So the formula is selling price times by the quantity sold minus with the variable unit cost times by the quantity sold and minus with the fixed cost. Then you can get the break-even point in unit. So in order for you to get this answer, then we just transfer all these informations to equations. So before that, let's say let Q, which means maybe you can use X, Y, Z or whatever numbers. Let Q is the numbers of units to be sold to break evens. So you just transfer the equation, which means that selling price. So how much the selling price is 70. So the 70 times by how much? Times by Q, because you not know which actually you want to find out the Q. So you need to time by the Q, and then minus with 42, okay, time by Q, and then you are minus with your fixed costs, 42 for 84,000, so equivalence to 0. Okay, so you solve this problem, this equation. So now you get 70 Q minus 42Q minus 84,000 equivalent to 0. So we simplify this equation, 28Q equivalent to 84,000. So when you divide by the answer for the Q is 84 divided by 84,000 divided by the 28, so you get the answer is 3,000 per unit. So this is by using the equation method. Okay, by using the same examples, we try to calculate in terms of this break-even point in unit by using the contribution margin method or CMU. So the formula is fixed cost divided by the CMU. You can get the break-even point in unit. So we just put here 84,000 feet, this one, divide by 28, margin, contributions margin method, 28. So how to get the 28? So you just minus with the 70 plus 42, so you get 28, equivalence to, so 84,000. Now I try to put 84,000 by divide by 28, then you get the answer 3,000 units. Okay, then how to calculate based on break-even in terms of revenues. So the formula actually is calculate the revenue is fixed cost divide the contribution margin in terms of percentage, and then so fixed cost is 84,000 divide by this the percentage in terms of contribution margin. In order to get the percentage is you have to calculate 28, you got the 28 divide by the 70 times by 100, and then you got the answer is how much? 210. Okay, so this is the break-even in terms of revenue. Okay, now with these same questions, we want to get the to get the answer through the graph method. Okay, so first we have to plot first. So I just estimation on the plots graph, and later on we want to draw the graph. So we need to first draw the total cost line. So in order for us to draw the total cost line, we should start with this the point at which the fixed cost intersect the vertical axis, which means that for instance, like this example, we are referring to 84,000. So 84,000. So this is the fixed cost. So this is the fixed cost, and then in order for us to draw the total cost line, so we need to come up with the assumption. Either we use 1,000 or 2,000, 3,000, 4,000 or 5,000. For this example, I think it's 2,000 units. So we produce at the 2,000 unit. So assume that we are producing 2,000 units. So like we assume 2,000. So the total cost 42 times by 2,000 plus 84,000. So equivalent to 168. So this is 106.80. So I'm using a different colors of so how to plot 68. Okay, 2000 here. So something here. So from this you can draw from fixed cost. Okay, so this line we consider like your total cost, your total cost. And then the next that we want to draw is total revenue lines. The total revenue lines. So okay, so we draw the total revenue line. So we should begin actually the total revenue line that begins start from you're not selling anything. You're not selling anything, which means at the zero, at the 0 point, you're not selling anything. Then um, what you need to do now is you just take any other same example like this. We consider that we are producing about 2000 we are about to sold about 2000 pans. Then we need to calculate with this selling price, so which means that 70 times by 2003. So at that 2000, you are selling about 140. So where is 140? So it might be here. So 2003, consider like here. So you have to draw from 0, and then you can get this line. Okay, from this you can find out that the intersect line is the break even is here. So when you see the break even here is how much? Okay, so it's a 3000. 3000 per unit. And then you can know the value also from here. So this is your break even, your break even point. So this is your break even point. So then this is how you can use the graph in order to get your value of units in terms of your break-even point. Okay, now let me see in terms of how to target of our operating income. So if you are referring to the formula fixed cost plus your target operating income, and then you are divided either by the contribution margin percentage or the contribution margin per unit. Okay, we are using the same example again to get the target operating income, but we put assumptions. How to get assumption here that management want to have an operating income 14,000. So how many pair of pen must be sold? So how many you want to sold in order to get 14,000 target operating income? So the examples, the formula actually is units to be sold equals to fixed cost plus target income divided by the contribution margin per unit. So you need to find the contribution margin per unit. From the previous example, your contribution margin per unit is 28. So this is the based on the previous example. So now, in order for you to get how much you need to sold, then you transfer lah. You put all this figure because 84,000 plus 14,000, and then you divide by this contribution margin per unit 28. 28 equal to 3,500 units. So this is your answer. And then second, what dollars says are needed to achieve this income? How much the ringgit Malaysia says the values in terms of values. So to get this actually is you need to revenue needed. The formula is revenue needed equal to fixed cost plus target income divide the contribution margin in terms of percentage. And then we know that this is the 40% from the previous example. So you just transfer 84,000 plus 14 divide the 14% and you get the 245,000. So this is the answer.